Stop scrolling. Stop checking your portfolio balance for the 15th time today. Stop refreshing the silver price chart like it's going to tell you a news story in the next 30 seconds. Because what hit the silver market in the last few hours wasn't a normal pullback. It wasn't healthy profit taking. It wasn't some tidy technical retracement a guy in a suit predicted with a trend line. It looked like a coordinated takedown of the most aggressive silver surge we've seen in a long time. And before we go any further, this is Chill Guy. If you want breakdowns the mainstream glosses over, hit subscribe right now, tap like, and drop a comment that says RJ Chill Guy, so I know you're locked in. One quick note, this is market education, not personal financial advice. I'm here to show you the mechanics so you can decide how to think, not what to do. Now, if you're thinking, relax, it's just supply and demand doing its thing, listen closely. Markets don't usually erase that much price that fast without a very specific pressure point getting pulled. When a move is that sharp, that sudden, and that perfectly timed, you need to ask what changed under the hood. Today is Tuesday, January 27th, 2026. This morning, silver printed $117.73 per ounce on screen, an eye-watering record print that lit up every bullish timeline. People who've been stacking for years felt vindicated. Momentum traders smelled a breakout. In anyone short, the market felt the room get very, very hot. Then the floor moved. Within roughly 4 hours, the price dumped hard, down into the low hundreds. A single session slide measured in double digits per ounce for anyone on leverage. For traders who chased the top with futures, it wasn't painful, it was a wipeout. Here's the key point. A fast crash doesn't automatically mean silver became less valuable. Industrial demand didn't vanish at lunch. Mines didn't suddenly double production. The real-world use case for silver, electronics, solar, electrification, didn't evaporate in an afternoon. What did change was the rule set and the liquidity. And in futures, rules plus liquidity is the whole game. There's one lever the futures exchange can pull that forces selling whether you want to sell or not. It's not a rumor. It's not a headline. It's a mechanism, a margin increase. On paper, it sounds boring, just risk management. In reality, when it lands at the wrong moment, it acts like a circuit breaker that can crush momentum instantly. Here's the simple version. A standard silver futures contract represents 5,000 ounces. You're not paying for 5,000 ounces in full. You post margin, a smaller amount that lets you control the position with leverage. There are two key numbers: initial margin, what you need to open, and maintenance margin, what you must keep to stay open. As long as your account equity stays above maintenance, you can hold. But when the exchange raises maintenance, your cushion disappears in one announcement. If margin is $22,000 and you're holding contracts, you're fine until the exchange changes the number. When the margin requirement rises, every open position has to bring in more cash immediately. Not next month, not when convenient, right now. And in early January of 2026, the exchange group behind COMEX Futures announced a major margin jump, about a 47% increase by widely shared reports. Maintenance margin moved from roughly $22,000 per contract up toward $30,500. That's an extra $10,500 per contract you have to post just to keep the same position open. Do the math. If a fund is holding 100 contracts, that's over $1 million of extra collateral that has to appear fast. If a smaller trader is holding 10 contracts, that's an extra $105,000. Most people don't have that sitting idle, especially after a run-up where they already used cash to add exposure. So what happens? They sell, not because their view changed, not because they stopped believing, because the rules changed mid-game and the cash isn't there. And it doesn't stop with the first wave of selling. Here's how the cascade usually works. You get forced selling from margin calls. That selling pushes price lower, which triggers stop-loss orders. Stops trigger more selling, which triggers more margin calls. Then the liquidations hit. Brokers close positions automatically to protect themselves. Then the high-frequency systems sense momentum and join the move. And suddenly you get a waterfall, fast enough that it feels like reality itself flipped. This is why the chart can look unnatural, even when nothing magical is happening. It's just leverage unwinding in a system designed to unwind leverage brutally. Timing matters too. This wasn't a random day in a sleepy market. Silver had pushed through key round numbers, hype was accelerating, and shorts were under pressure. When markets get stretched, a margin change is the cleanest way to cool them down without saying, we wanted it lower. And we've seen versions of this movie before. In 2011, silver ran toward $49 and the margin requirements were increased repeatedly in a short window. After the squeeze cooled, price dropped hard. Back in 1980, rule changes around positions and trading conditions helped reverse a historic run. I'm not saying history repeats perfectly, but the playbook rhymes. Now, does a margin hike prove someone is pulling strings? A margin hike by itself is an exchange tool, and exchanges say it's about volatility and risk. But it absolutely does one thing with zero debate. It forces liquidation on leveraged longs at the worst possible time. And it can hand breathing room to whoever is trapped on the other side of the trade. There's another layer here we have to handle carefully, because words matter. Big banks and major dealers have been caught manipulating precious metals markets in the past. Legally established cases exist around practices like spoofing. One major bank paid a record settlement in 2020 related to metals market misconduct. That doesn't prove today's move was bank operated, but it does prove this arena has a real history of games being played. So instead of yelling conspiracy, let's focus on what we can observe, what paper can do, what physical can do, and where stress shows up. Because the real story isn't the screen, it's the gap between the screen and the metal. While screens were dumping in New York, physical markets in parts of the world were reportedly trading at meaningfully higher levels. People have shared reports of premiums that stayed stubborn, sometimes massive, because real metal doesn't appear on command. Coins and bars have to be minted, shipped, insured, and delivered. And when supply is tight, the spot price becomes more like a reference than a guarantee. If you've ever tried to buy during a squeeze, you already know this. The chart can say one thing while your local dealer says, that price doesn't exist. This is what I call the great divorce. Paper and physical stop moving together. Paper can be sold infinitely. Contracts can be opened and closed with a click. But physical silver has to exist, at the right purity, in the right form, in the right place.